Americans are waking up to the reality of higher fuel prices.
The price of gas in Europe is more than double the level.
Brent just crossed $115 a barrel. Americans are paying close to $4 a gallon at the pump. Across Europe, energy bills are back to levels that triggered street protests 3 years ago. Every front page runs the same story: the price of fuel. Fuel is the distraction. The real damage isn't at the gas station. It's in every factory, every container ship, every supply chain that touches Asia. And almost nobody is covering it. The war in Iran shut down the Strait of Hormuz. The Suez Canal has been crippled by Houthi attacks for months. 2 of the 3 major shipping lanes connecting Asia to the West are shut at the same time. The only route left goes all the way around the African continent. That means 2 extra weeks on every delivery, freight rates climbing by the day, and insurance premiums so high that some shipments are simply not worth sending anymore. If you run a business that sources anything from Asia, and I don't just mean China, I mean Vietnam, India, Bangladesh, Thailand, your margins are about to get brutally squeezed. The last time something like this happened was 2020. Except this time, it's not a virus shutting down factories, it's a war shutting down the ocean. By the end of this video, you'll know exactly how this crisis is going to hit your business and the 3 moves you have to make right now to protect yourself before the hits the fan. If you're running a business or thinking about it, this channel is for you. We break down what's actually happening in global trade, Asian markets, and cross-border business from the inside, because we operate in this world. Hit subscribe, it's free, and every video will save you from a mistake that costs real money. So you've heard the oil number. It's everywhere on the news. But your business doesn't run on crude. It runs on products, components, raw materials, and the real damage is hiding behind the barrel price. Start with what comes out of oil, that isn't fuel, naphtha. You've probably never heard of it, but it's the base feedstock for nearly every plastic on the planet. Your product packaging, your shipping materials, the containers your goods sit in. The Middle East is the world's largest source of naphtha, and there's no substitute. When Hormuz closes, the raw materials behind every plastic component in your supply chain get scarce and expensive at the same time. Aluminium follows the same pattern. Gulf countries produce nearly a quarter of the world's aluminium supply outside China. Prices on the London Metal Exchange have already blown past $3,400 a ton. That hits everything from beverage cans to electronic housings to the foil that lines food packaging. And while I'm talking about food, 1/3 of global seaborne fertilizer trade passes through the same strait. Urea prices have jumped from around $450 a ton before the war to roughly $700. Fertilizer doesn't sound like your problem until you realize what it means. When fertilizer gets expensive, food gets expensive. When food gets expensive, inflation reignites in every economy where your customers live. The purchasing power shrinks before you even touch your prices. None of this is speculation. Over the past few weeks, we've been hearing the same thing from entrepreneurs across the world. Freight forwarders adding a line they've never seen before: war risk surcharge. Shipping quotes up 30% overnight. Suppliers sending emails at 2 in the morning with a new price and a deadline to accept. No discussion, just a number. These aren't oil traders. There are people selling skincare from Thailand, electronics assembled in Shenzhen, furniture from Vietnam. Their margins were already tight. Now, every layer of the supply chain is repricing at the same time. So costs are going up. That part is clear. But here's the question that should keep you up at night. Can you raise your prices? Before I answer that, 84% of you watching this aren't subscribed, which means the next time we break down something that could save your business thousands of dollars, you won't even know it exists. So please subscribe to the channel and save your money. In 2021 and 2022, when COVID disrupted supply chains and inflation started climbing, most businesses could pass the cost on. Customers were flush with stimulus money. Demand was high. You raise your prices 10, 15%, and people kept buying. It wasn't comfortable, but it worked. This time, the math is different. Central banks spent the last 2 years fighting inflation by raising interest rates. Mortgages cost more, credit card debt costs more, business loans cost more. Your customers, whether they're consumers or other businesses, have already been squeezed for 2 years straight. They don't have the same cushion they had in 2021. So you're caught in a trap. Your costs are climbing because of the war, but your ability to pass those costs on is shrinking because your customers are already stretched. You hit the margin or you lose the sale. Pick one. Economists have a word for this: stagflation. Pricing is going up while the economy slows down. It happened in the 1970s and it was also triggered by oil. Back then, the Arab oil embargo sent energy prices to the roof, which drove up the cost of everything else, and the economy stalled for nearly a decade. Living standards dropped, businesses collapsed. The Federal Reserve tried to fight it by raising rates even further, which made borrowing so expensive that it crushed growth entirely. The scary part is how similar the setup looks right now. Oil above $100, driven by a Middle Eastern conflict. Inflation, that central bank thought they had under control, suddenly threatening to reignite, and the Fed stuck in a corner. Cut rates to help the economy and you risk fueling inflation. Keep rates high to fight inflation and you choke the businesses that are already struggling. There's no clean move. Jerome Powell said a few weeks ago that he doesn't think the current situation compares to the 1970s. Maybe he's right, but he also said the economic climate was
very difficult situation.
When the chairman of the Federal Reserve calls it difficult, that's panic in a suit. What does this mean if you sell products? If you run a business with thin margins, the next 6 months are going to test you. The entrepreneurs who survive this won't be the ones who waited to see what happens. They will be the ones who moved early. Which brings us to the part you actually came here for. In early 2020, a container from Shanghai to Rotterdam cost around $2,000. By the end of that year, it was $8,000. 6 months later, $15,000. Some routes hit $20,000. Entrepreneurs who source from Asia remember this vividly. You'd place an order, confirm a price, and by the time your goods were ready to ship, the freight cost had eaten your entire margin. Some people sold products at a loss just to keep their customers. Others couldn't ship at all and watched the inventory rot in a warehouse in Guangdong. But not everyone got burned the same way. The businesses that came out of COVID in the strongest position did 3 things before the crisis peaked. First, the businesses that survived locked their production costs early. While everyone else was ordering month to month, hoping prices would stabilize, they went to their factories and signed longer contracts at fixed prices. They placed larger orders up front, sometimes before they even had the demand confirmed. They understood that in a crisis, the cost of being wrong by a few units is nothing compared to the cost of buying at the peak. Right now, most suppliers in Asia haven't fully adjusted their pricing yet. Some are testing the water with 10 or 15% increases. Others are holding, waiting to see how long the war lasts. That gap between where the prices are today and where they're going is your window. Once suppliers realize the disruption isn't ending next week, the increases will come fast and they won't be negotiable. Next thing, they secured their logistics before the bottleneck hit. Container slots, freight capacity, warehouse space, all of it can be reserved in advance. During COVID, the entrepreneurs would pre-book their shipments months ahead, paid a small premium for guaranteed space. It felt expensive at that time. 3 months later, spot rates had tripled, and those pre-booked slots looked like the best deal they'd ever made. The same logic applies now. Freight forwarders are already adding war risk surcharges and fuel adjustment fees. Those charges will only go up as the Cape of Good Hope route gets more congested. If you wait until every container is booked and every slot is full, you'll pay double and still wait weeks for availability. Talk to your logistics partner now. Lock in rates, lock in capacity, and ask specifically about surcharge caps so you don't get surprised by fees that escalate with no ceiling. More importantly, they hedge their currency exposure. This one gets overlooked because it feels like a finance problem, not an operations problem. But when oil spikes, currencies move. The dollar tends to strengthen in a crisis because investors run to safety. That means if you're an European entrepreneur paying your Chinese supplier in dollars, your costs just went up, even if your suppliers didn't change a thing. During COVID, some businesses saw their currency losses wipe out whatever savings they had managed on production and freight. The fix is straightforward. You can lock in an exchange rate in advance so you know exactly where your costs will be regardless of where the market moves. At Statrys, we see entrepreneurs do this all the time when they anticipate instability. You set a target rate, you lock it, and you lend landed cost stays predictable. In a period where everything else is moving, knowing your FX cost is fixed gives you one less variable to lose sleep over. The entrepreneurs who lost the most during COVID weren't the ones with the worst product or the smallest budget. They were the ones who waited for things to stabilize, for freight rates to come back down, for the supplier to absorb the cost increase. That wait cost them months of margin destruction. Right now, we're in the early phase of this cycle. Prices are moving, but they haven't peaked. The window is open, but it won't stay open long. Trump said this operation will take 4 to 5 weeks. Yet, at the moment I record this video, war continues. The pressure on shipping lanes, commodity prices, and currency markets builds a little more. The question isn't whether your costs are going up. They already are. The question is whether you'll have locked yours in before your competitors do. If you want to see how locking a rate actually works, there's a link to Statrys in the description. You can open an account in minutes and start converting currencies at rates that won't move on you overnight. No minimum deposit, no hidden fees. Just one less thing trying to eat your margin while you sleep. If you've been through something like this before, whether it was COVID, the 2022 energy crisis, or even the oil shock in the 70s, if you've been around that long, drop your experience in the comment. What worked, what didn't, what you wish you'd done sooner? That kind of knowledge is worth more than any headline. See you in the next video.